You check your bank balance. A number is there. It feels solid, real, earned. But here's the uncomfortable truth. Most of that money was never printed, never touched ink, never passed through a mint. It appeared, quietly, legally, with a few keystrokes. And once you see how that happens, it's hard to unsee. Because the system that creates money today doesn't look like the one we were taught in school. It doesn't run on printing presses. It runs on promises. And right now, those promises are everywhere. This matters now because we're living through an era where money feels strange. Prices jump faster than salaries. Debt feels normal. Governments spend numbers so large they don't feel real anymore. And central banks insist they aren't printing money, even as the amount of money keeps exploding. So let's slow this down, strip away the jargon, and follow the money from the moment it comes into existence. Not metaphorically, literally. Start with something familiar. You walk into a bank. You apply for a loan, a home loan, a business loan, even a credit card. You sign papers. The bank nods. Approval granted. Now pause. Where did the money come from? Most people imagine a vault, stacks of cash, other people's deposits being handed to you. That's comforting, and mostly wrong. In modern banking, when a bank approves your loan, it does not take existing money and give it to you. It creates new money out of nothing. The moment the loan is approved, the bank types a number into your account. That number didn't move from somewhere else. It didn't exist before. Your loan created a deposit. On the bank's balance sheet, two things happen at once. You get an asset, cash in your account. The bank gets an asset, your promise to repay. Money is born as debt. No printing, no trucks, no vaults opening, just accounting. This isn't a loophole. This is the core design of the modern money system. In most developed economies, over 90% of all money is created this way, by commercial banks, not by governments, not by central banks. When loans expand, money expands. When loans shrink, money disappears. Yes, disappears.
When you repay a loan, the money used to repay it is destroyed. The deposit vanishes from the system. Money today isn't a thing, it's a temporary agreement. Now here's where it gets interesting. Banks can't create infinite money. They're constrained, but not in the way most people think. They're not constrained by deposits first. They're constrained by profitability, regulation, and confidence. If a bank believes you can repay and regulators allow the risk, money can be created. So during good times, optimism, growth, rising asset prices, banks lend more. Money supply grows. Everything feels easy. During bad times, fear, defaults, falling prices, banks pull back. Money supply contracts. Everything tightens. The money supply breathes with the mood of the economy, which means stability depends on psychology. That's already a little unsettling, but we're not done yet, because there's another layer sitting above all of this, the central bank. The institution people think prints money. In reality, central banks usually don't deal with you or me. They deal with banks. When a central bank wants to stimulate the economy, it doesn't mail cash to households. It changes incentives. Lower interest rates, easier lending conditions, cheaper borrowing. It whispers to banks, go create more money. And banks usually listen. Sometimes, though, even that isn't enough. That's when central banks do something that sounds technical, but changes everything. They buy assets. Government bonds, mortgage securities, financial instruments. They pay for these assets by creating new reserves, again, digitally. This is what people call money printing. But notice the irony. The new money mostly enters the financial system first. Not wages, not groceries. Assets, stocks, real estate,
bonds, which helps explain something many people feel but struggle to articulate: why asset prices soar while everyday life feels tighter. Money is being created, just not evenly. Now let's talk about the uncomfortable math, because money created as debt has a built-in problem: interest. When a bank creates a loan of 100, it creates 100 in new money, but you owe more than 100 back. Where does the extra come from? From other loans, from other people going into debt. The system requires continuous expansion to function smoothly. New debt to pay old debt. New money to service yesterday's promises. This doesn't mean collapse is inevitable, but it does mean stagnation is dangerous. A system built on growing credit struggles in a world that stops growing. This is why recessions feel brutal and why policymakers fear deflation more than inflation. Deflation makes debts heavier. Inflation quietly erodes them. Now contrast this with the story we're told. The hype says money is controlled, managed, carefully measured. The reality is messier. Money creation today is decentralized, profit-driven, and reactive. It responds to incentives, to fear, to optimism, which means the system amplifies cycles instead of smoothing them. Booms feel amazing, busts feel catastrophic, and the people least involved in creating money, workers, savers, cash holders, often feel the consequences the most. Zoom out even further. Governments run deficits. They issue bonds. Banks buy them. Central banks buy them from banks. New money flows in a loop. Debt becomes the foundation. Trust becomes the glue. As long as people believe the promises will be honored, the system holds. When confidence cracks, things unravel fast. History is full of these moments, not because money stopped working, but because belief did. So where does that leave us? Living in a world where money isn't scarce in the way we were taught, but stability is. Where numbers grow faster than real output, where wealth feels abstract, and where the line between money and debt is almost invisible. And maybe the most unsettling question isn't whether money is real, it's this: if money can be created without printing anything, who really controls how much of it exists, and who pays the price when the promises go wrong? That question doesn't have a clean ending, and that might be the point.